Alrighty. Well, welcome to, hey, Dan. Welcome to our webinar on estate planning and asset protection. I I have never done it ever, I don't think, in my life where I cancelled a webinar on the day of the webinar, but or I rescheduled it. But that's what happened with this one because I was quite ill on the morning of a few weeks ago when this original date was scheduled for this estate planning and asset protection webinar. So I appreciate the patience in rescheduling it, and I hope that you get whatever you're looking for out of the topic we're going to chat through today. Now, in terms of a little bit of a checklist for maximizing interaction, for those who are keen to do it, pop your cameras on. It makes me feel like I'm in a little bit more of a workshop rather than talking to a screen. And the other one is because I'm presenting my slides on the side of it's almost sort of like the side of my webcam. You're going to need your Zoom larger to see the details on the slides as we go. And also, I've got plenty of time built into the webinar for questions. So please, if anything, you want to clarify anything I'm talking about, or even take it a step further from if I'm not quite explaining something that relates to you and you want to sort of see how it applies, then please pop a message in the chat box, or also very welcome to take yourself off mute and we can literally have a conversation. That is the benefit of doing things as a Zoom meeting, not a Zoom webinar. For those who are joining who don't know who I am or what I do. So my name is Ben Walker. I run an accounting firm called Inspire, and we work with small business owners all around Australia. But we're based in Brisbane in the Fortitude Valley. We've got a little bit of a knack for saving our clients tax, and that we started counting in 2015, the impact that we had in terms of our tax savings for clients, and that number just keeps on going up and up each year. So we're sitting at a tally of currently 46 million bucks, which, looking back over the last decade and a bit, I feel it's pretty impressive to have put back in the hands of the families who run the small businesses that we work for. So really proud of our team for that. If you aren't working with us and you are keen to explore what it looks like, the way to do that is to book an initial chat with one of our accounting team. If you are working with us, because I know there's at least definitely a few clients registered for this webinar, and you want to talk more about estate planning and our process and or even asset protection, then feel free, please, to reach out to the accountant that you work with at Inspire, and they'll be able to help you implement the stuff that we're talking about today. And oh yes, anyone who so I wrote a book called It's All Sorted, which is focused on basically a 9-step guide to help business owners save tax and sort out their accounting dramas. There's a good few chapters that talks to asset protection and structures. If anyone's looking for more on the estate planning side of things, I wrote another book that's got a purple cover called Wealth for Life. So it's not on the slide here, but that talks a lot more towards the estate planning considerations that you might need. If you're a client, you do want a copy of those, just send me an email or one of our team and we can get a copy to you. And if you're not working with us, there's a QR code on the screen to order one of those or both of those from the website. And a bit of a personal introduction. I started Inspire quite a while ago now when I was 23 years old. I'm an award-winning chartered accountant with over 17 years experience. And I've already mentioned those two books that I've written, Wealth for Life and It's All Sorted. My message and passion is really helping small business owners and the families who run them, really succeed when it comes to the accounting and financial side of their lives. Having both my dad who ran a small business and my grandfather as well, it's close to my heart, and love the impact we can have with clients. Alrighty, so we might get stuck into the juicy stuff, and we'll kick off with asset protection and sort of context around that, because I think some of the stuff I'll talk about is relevant when we start talking about estate planning as well. And some of you might have seen this diagram before, but and I'm sort of stepping back a bit from asset protection to just go through the why and the functions of how we might be able to achieve this. But basically, here's the three types of business structures available to you to run a business, or even to structure investments and that sort of thing in Australia. Now, there's a few different types of trusts. SMSFs is actually a type of trust that has its own sort of way of getting taxed, but that's also something else to consider as well. But basically, in terms of tax rates, that's one thing to compare these structures on. As an individual, you're sitting at up to half your profit or half your income that gets taken by the tax man. I probably wouldn't donate that if I didn't have to. If we switch gears over to companies, companies that run small businesses pay tax at 25%. Or if you, and I'll skip to the next one really. So if you run your small business in a trust and your trust distributes to a company, often we call that a bucket company or a corporate beneficiary, or even a holding company, depending on there's all interchangeable names for the same thing. Basically, a company receiving distributions from a trust that runs a business, you're also looking at that 25% tax rate. If your company predominantly invests in stuff and doesn't receive that business income, your tax rate reverts to 30%. Or if you turn over a bucket load of turnover as well, even as a business, you pay that high rate of tax. So there's sort of a high level comparative of the tax rates between the entities. If we look at asset protection, there's definitely better structures than others. So why individuals have a cross in the asset protection box is because we don't want people running a business as a sole trader or even as a partnership of individuals, because if anything goes wrong in the business and the business is sued, technically the individual, then any assets that they've built up in their own name can be used to sort of pay out creditors or might be chewed up in a liquidation or bankruptcy. So it's not ideal. If we look to company and trust structures, there's definitely a lot more options we have when it comes to asset protection in companies or trusts, and even more so in SMSFs. So, when it comes to SMSFs, unless you've structured contributions and done things knowing that something bad's about to happen, your superannuation generally is safe, even in the event of like a personal bankruptcy. So it's really quite protected in super. And that last row there, tax planning, again, sole traders pretty tough to get any form of tax planning with, but companies or trusts, we've got some flexibility, we've got better tax rates, and even with trusts, you've got the ability to distribute within the family group to entities or people who might have a better rate of tax as well. So that's an overview of structures, and I feel like that's relevant as we talk through these other couple of topics. The next thing I'd like to cover is why are we worried about asset protection? So, I sort of look at asset protection is you don't appreciate it until you're in a position that you need it. It's just one of those things where, we can stress it as much as we feel, and we've seen clients where, there's liquidations. I haven't seen a bankruptcy, I don't know, in a very long time, but we've definitely seen liquidations. Nothing too horrendous in our own client base, but even people I know in business, especially when a while ago the rules around education and TAFE, Cert 3s and Cert 4s, all of that changed probably about 6 or 7 years ago now. And a lot of businesses in those industries just got mulched up when the government essentially stopped paying how they used to pay. And one friend I knew in business, they were sort of later on in age, business was growing really fast. And then what ended up happening is those changes meant massive cash flow pressures in the business. And they ended up basically losing the house and their retirement that they'd built. through the value of their business, just like literally over a matter of weeks. So it can happen, and it can happen to good businesses. It can happen as a result of even something that might affect you from a health perspective. You lose momentum on the business, and then these things start to pop up. So yeah, they're real, and I see it. Thankfully, not so commonly, but there's things you can do to reduce the risk. So what are we worried about from a risk perspective? The question to ask is who's going to sue us and for what? So the first one here is clients could sue you. I sort of feel like this depends on the industry that you're in and the damage that could be done as a result of, I guess poor work that you've done, or accidents, mistakes, whatever it is. And there's something wrong between yourself and the client, and they end up suing you. Um, yeah, and again, I don't know, like businesses with a lot of clients, I don't know that that's too much of a risk, but it definitely is one thing that we want to be conscious of. The next one is suppliers. And I sort of think about this as people you pay money to, which includes people like the ATO. The ATO is often people's biggest creditors because we pay BASs in business, we pay as you go installments, tax, all those lovely things. And they tend to be the people where, at least at the start, they're not going to jump up and down too much if you miss the BAS due date by a few days, weeks, whatever. You miss a mortgage repayment, the bank's going to jump up and down and whatever. So in terms of the order of what people normally leave to the last, that's essentially why the ATO is the biggest creditor for small businesses. And they can do things to make your life difficult as a result. So, we've seen garnishee notices. We've also seen DPNs, and I might loop back to DPNs as we go through these slides because yeah, they're interesting. But even suppliers like landlords, what we've got to be aware of there is that often in commercial leases, there's clauses to say that if the entity doesn't pay the bill, then the landlord can come after the director and the personal assets of the director. So yeah, suppliers are one. If you depends on your business, but if you've got other key suppliers, or even even within IT businesses, suppliers like Apple or Microsoft are going to have like really solid terms and conditions. And Apple, for instance, are really tough to work for, and you basically got to submit to their every request. So yeah, got to be careful and wary that suppliers is another way that that people can sue you. Employees, yep. I've probably been saying this message for a decade now. It seems to get worse. But employment law in Australia is definitely not written in the favour of the employer. Even more so with our current government. The benefit or the default position is given to the employee. If someone wants to make a menace of themselves, it's quite simple and low cost for them to do so. But even if you make a genuine mistake, employees can cost you a fair bit through Fair Work or any other sort of avenue there. And I guess maybe that's another point that's brought up for me is that, one level to mitigate a lot of these things is to have insurance. So things like management liability insurance is a risk mitigator for the risk that employees give. So, maybe a good chat to your insurance broker, if you have one, would be a good thing just to discuss the different elements of risk in your business. And there's heaps, like, there's even, I haven't got it here, but there's like cyber insurance and cyber attacks and, things like that. Like that's, often they could ransom, hold your stuff to ransom, pay me $100,000 and I'll unfreeze your SharePoint or your Google Drive, whatever you use. That can cost a lot of money and put massive financial pressure on businesses. So yeah, insurance might be going back to clients as an example. So professional indemnity insurance, depending on the industry, is a way to mitigate the risk that clients could successfully sue for, for stuff that costs you out of pocket in a significant way. The last one here is competition. So yeah, a bit of a wild card here, but probably going to be inadvertent unless you're intentionally being a muppet within your industry. But if you go and breach someone's intellectual property, so you start calling yourself, like literally it happens. I've found other accounting firms calling themselves Inspire Accountants or Inspire Tax, stuff we've got trademarks for and bits and pieces. You risk getting sued in that instance. So yeah, fun time to be in business and all these lovely risks we put up with. So, but what I wanted to do is just give examples of what I've seen in the past and when things don't go rosy, what is often the areas or the places that they can go wrong. And how I usually describe risk is there's a continuum of risk. So situations that I would suggest are high risk and situations that are low risk, or how do we sort of reduce our risk when it comes to asset protection? Um, After almost a couple of decades of working with small business owners, the other thing I realize is that different people have different tolerances to risk. I've met um, I've met extremely wealthy people that really don't care about asset protection, and I've met people without much assets that really care about protecting. And sometimes I'm not meaning this to be offensive, but they want to spend 20 grand on a crazy structure to protect nothing, like literally, like the future. And I've got a belief that you got to set stuff up with the future in mind, but there is a process and a order that which you can implement things and yeah, so often it's challenging as an advisor to try to understand where the client sits on that spectrum and or continuum, and then working out what things we want in place. But I guess just generally, what makes things more high risk is that if you run your business as a sole trader, thankfully, I don't see a lot of that. People still do it. It's the cheapest way to run a business in terms of administration and accounting costs, but it's high risk. Tax is a crap outcome. And yeah, asset protection. I mean, if you've got assets in your own name, you're exposing those to the risks of running your business. If we move further to the right side here, where we got lower risk on the continuum, having a company or trust takes you definitely along that line. The reason why a company or a trust with a corporate trustee takes you further along this line is because of this concept of being a separate legal entity. So the director of the business is a separate legal entity to the actual company or the trust with a corporate trustee itself. That's called ASIC's corporate veil. And the way I put this on the slide here is this sort of brick wall in between you as the person and the company a bit further up there. So so it doesn't mean that if you've got a company or a trust that your personal assets are protected. It absolutely doesn't. In fact, if I scroll back to the example I gave about the friend in education who lost everything, they had companies and trusts and all sorts of structures in place. But there's things that can get through the corporate veil. Now, the first one there is fraud. I'm absolutely not suggesting that friend did that, but fraud is something that the courts will suggest that, hey, we should be able to take your personal assets. I agree. I don't object to that being a reason for people to lose their assets. If someone's intentionally gone to take people's money away in a fraudulent way. The next one here, and this is where that situation went bad, is a director's guarantee. So the director's guarantee basically says if the entity can't pay the bill, I can come after the director. And this is very common in leases, asset finance. Maybe a supplier like an Apple might sneak that into a contract. And again, just having a little bit of insight to what happened. Even banks, if you've got funding for the business that's secured on your house, well, that's slightly different to a director's guarantee. That's security. But yeah, security of a personal asset for a business purpose. That's another way to lose personal assets and breach that corporate veil. Insolvent trading, this is probably the most common way that you can expose yourself in the corporate veil. And that basically, so insolvent trading is basically the entity, the trust or the company with a, the company or trust, if it cannot pay its bills as and when they are due, there may be insolvent trading happening. And it has to be proven and all this sort of stuff, and then personal assets can get exposed. That's part of the liquidator's process is to pursue directors if they feel they have insolvently traded, like it's a thing, and again, personal assets exposed in that instance. The other one here, super or pay-as-you-go withholding. There's a couple of ways that debts of the business, particularly to the ATO, can become personally liable. So it's not a director's guarantee in particular, but if you lodge your BAS statements late, and I think it's by 3 months. If you're more than 3 months late, the amounts that are on your account that are owing in those BASs are not only liable by the entity, they're also liable by the director as well. Superannuation is another one that if the entity doesn't pay, you're sort of forced to pay it as a director. And then DPNs. So the ATO have a number of different ways that they can extract money from you. One of them is asking for it, which is the most common, with the threat of fines and interest and penalties if you don't do that. And then if you ignore that, or then they can just escalate their process, which sometimes looks like garnishee notices. That means they write to your bank and say that, okay, there's 100 grand in that account. Here's essentially an enforceable order to pay me 20, 30, 40% of that balance immediately. And the bank has to comply. They can also garnishee to your key customers. And we've seen this before. I've seen it for the first time probably in the last 12 months. They said, hey, you owe this entity a couple hundred grand, but they owe us way more than that. So you're going to pay 40% of what you pay to them directly to us, and you skip them. So that's called a garnishee. So it can happen to banks or customers. And then the other one is DPNs. So, or director penalty notices is the acronym spelled spelled out. So with DPNs, that basically says the amounts that are owed by the entity, you've got 21 days to do something about, otherwise they'll become personally liable. So that's one type of DPN, and the other one is too bad they're already personally liable. So what happens is, and literally on the ATO portal, if someone's got a DPN that's attached company or trust debt to their personal, like their person, the director, we'll log into the individual tax portal of the director, and we'll actually be able to see not only the tax debt of the individual, so their income tax or their BAS debt if they've got it, but also the debt that they're severally liable for of the entity itself. So it's a really I guess not a great thing to happen, and obviously DPNs are quite down the track. You've had to have ignored a lot of the advancements or the advances of the ATO to end up in a position where you're getting DPNs. So, but it happens, and they're firing them out like mad at the moment, the good old ATO. So if you get one, get advice, get legal advice, get some advice around what to do with it, also from your accountant as well. So yes, so the essence of so to sum up this slide and what I've just spoken about for the last 5 or 10 minutes, is that just because you have a company or trust does not protect your personal assets from many of the risks of running a business. So what do you do? Cool. Well, it's on the slide here. It's basically you be worth nothing as a director. Now that's it might be an interesting concept depending on how your assets are structured right now. But how we often do it is that if we've got let's say we've got a husband and wife, and one of them is I guess, the primary face of the business, they usually take on the risk taker persona. So they would be the director of the trading entities, and the director of the trustee companies if they run through a trust. Basically, any position of risk in the family group, that's who takes it. We've sort of got the risk taker. And ideally, they hold no assets. So between myself and my wife, Stevie, I'm the risk taker. So literally no part of the house in my name, but a share of the debt attached to it. So yeah, in terms of even like a $0 position, that's good. But even if you can have a negative position, you become even more unattractive to chase in the event that something goes bad. And then what does the asset holder role look like? Well, they would ideally have control of all the assets and all the holding entities, the things that own the value. 100% ownership of family assets such as the family home or cars. And the typical roles we see in the entities is the shareholder role would be this person. And again, I say depending on the exact structures, or the trustee of a trust, the director of a trustee company that holds assets only, does not trade, or even the appointer role in discretionary trusts. So, there's a few different lenses that the asset holder would take when we structure businesses and investments within a family group. So is that making sense? We can do a little thumbs up or down. You got your camera on, you can nod. Love the good old um,
Yeah,
reactions now into.
it's pretty good, mate. It's pretty good. I think probably the most confusing part is between the risk taker and the asset holder, right? Because I mean, I
Mm,
guess in my circumstance, me and my wife have our house together, and we're
mm,
also directors of my trustee of the trust. So what we would do in this instance would be we'd separate the asset holder from the risk taker, but then to the bank, we would be removing one of us from the loan, from the mortgage loan. So I guess the question there would be, how would that look to the bank if we took one of us off the mortgage? Because they'd say, well, there's only
mm.
one person here now, how would they look at that income wise and all the rest of it?
Yeah, great question. Um, so I mean, it's not uncommon for one spouse to own the house, and this is like our exact situation here in the house I'm sitting in right now. One is the asset holder, and there is two of us as borrowers, basically. So we're still both on the mortgage. It's just I'm not on the title. So that's the distinction. Now, it's very common for clients to come to us in a situation like you are, so joint owners in the family home. It's so common, and for people who haven't had this education, it just makes sense to just buy it in both names. To change it though is going to cost money. Um, so if you wanted it just in your wife's name, for instance, you'd pay stamp duty on the share that you move in. We've essentially laid that out for a client before. They were in a position. They were a director in a publicly listed company, which again you've got less control over that, insolvent trading than you do as a small business owner, I feel. So he was really risk adverse, and he paid stamp duty to get his half of the house out of his name. Um, there's other measures like a gift and loan back strategy that we can look at that avoids stamp duty but transfers the equity in your home to I guess a special type of trust, and that's another option. It's not as clean as transferring your half though. So yeah, lending wise, it doesn't seem to impact. Sometimes, like I've had, through the mortgage broker we work closely with, the bank will sometimes ask why is this happening, and it's like spouses. It's easy to share, asset protections. The reason, and the bank will just go, yeah, okay, got it. Um, and then the other one we see, so sorry, you're saying if you're both directors of the trading entity, you could consider taking one of you off.
Yep.
Um, now, I would suggest taking the person that is less the face of the business. So you can take a director off, but there's also a risk called shadow directorship. So if the person is, engaging contracts with clients, hiring and firing team, but they're not a director and they're doing other responsibilities, they could be considered essentially a director anyway. So sometimes it's impossible to avoid, but in situations where that's not the case, it might just be easier to take your spouse off as a director. Um, and the other challenging situation we get is when both husband and wife, or both spouses are um, running their own business. So who's the asset holder and the risk taker? And sometimes it's essentially impossible to do that. So we need to look at things like gift and loan back strategies, or any even the family car you own in a trust, not your own name, and things like that. So it does get challenging. Yeah, particularly on what you or your spouse does. So yeah, does
Too
that?
easy. Yeah, it's good, mate. Thank you.
Yeah,
Cheers.
awesome, very good. Alrighty. Yeah, and as I said at the start, I think a few people have joined since I kicked off. But if you've got questions, there's two ways to pop them to me. One of them is just what Dan did there and take himself off mute, and just ask the question, or the chat box is something I've got up on my screen. I'll be monitoring. Okay. So yeah, just in terms of like, if you want to go further with this stuff, with Inspire, we can have more chats about who should be the risk taker versus the asset person. We can have a look at existing structures, review it not only for asset protection, but to make sure you're getting the most out of it from a tax efficiency perspective. And then if there's any strategies we can suggest to you to better your asset protection position, and there's a few of them here. Then we can run through those options. So again, if you're working with us as a client already, just reach out to the accountant that you work with to have a discussion around this stuff. If you have any questions. So we're about to change gears from from asset protection to leaving your legacy, which is my way of referring to estate planning. Um, all the documents that deal with when you die or lose your marbles. Um, oh dear. Another necessity in life, unfortunately. Death and taxes. So we cover parts of both. So anyway, so yeah, kind of any last questions for asset protection before we move on? Yes, Dan, both guaranteed. Lots of taxes in Australia. Dear. The tax on the spare bedroom, that really got me. I'm just like, you are kidding. Someone is dumb enough to suggest that. Make a joke of themselves. Anyway, all right. I didn't see any other questions, so we might kick on. So, what is estate planning? Well, it's not just doing a will, but even then, there is and this stat changes, or it might be different if you Googled it, or found some other research paper, or even what I've got on my slide here. But the majority of Australians die without a will. And as a business owner, it's really not a nice thing to go and pick apart when you've got companies and trusts, or even an actively trading business. It's a complete mess if you don't have this, estate planning stuff sorted out. The other consideration is that for business owners, a will only deals with assets in your own name. So when we've got assets in trusts and companies and SMSFs, we've really got to consider what documents we might need for each of those categories of ownership of things. And so I've built this table here that shows, assets held in your personal name will be dealt with through your will. Assets in joint names, and I put in brackets joint tenants. So let's say it's very common for the family home to be owned jointly as joint tenants. We don't want that for asset protection perspectives, but as Dan shared then, that's real for him. If someone as a joint tenant was to die, the rule of survivorship says that it goes to the remaining living spouse or whoever, and it doesn't have to be a spouse to be jointly owned, but yeah, the rule of survivorship means it skips the will and goes straight to that person who owns the remaining part of it jointly. Um, Assets held in companies are technically owned ultimately by the shareholders. So it's important we understand who our shareholders are. Now, they will often be trusts if there's value in the company, or if, and we're structuring it, or individuals as well. So trustee companies are, we usually set up with individual share owners or shareholders. And so that's where your control will end up, and the assets in the company, the value will sit with whoever owns it and be dealt with. So if it's a trust, for instance, which is my next line here, a discretionary trust, we need to have a look at the deed to see when the controller of the trust passes away or loses capacity to make decisions. What happens? Does it go to, and it's very common for it to go to the legal personal representative, which is another way to say the executor in in that person's will. So very common to have your spouse as your executor. But what happens if you both cark it? You need backup executors, and so what you need to work through is, let's say you've got an actively trading trust that runs a business. You pass away. Where does the control go? Think through that. Maybe through your will, if it's your legal personal representative, your executor will end up controlling that trust. Now, that might be separate to who you want to benefit from that trust. So you've got to really think through who you want ending up with it, and also what instructions you want to give with it as well. We're starting to get pretty powerful, big questions and sort of morbid a bit, but we got to again, one option is to just imagine you'll never die, and the other option is to deal with it, and as hard and confronting as it might be. So Dan just popped a question. So it doesn't automatically go to beneficiaries such as kids. No. So if you die without a will, if you die without a will, the government essentially has a process to work through that, and often it will just go to your spouse. And there's ways we would prefer it sometimes to go to your spouse, not directly. And I'll share on another slide the other option soon. Kids under 18, yeah, I mean I haven't seen enough of dying without a will to um, to know it well. I did have a mate when I was in my early 20s. His father passed away, separated from his mum, and it was a massive mess for him to pick through. And he wasn't even a business owner. Like, he just had a home, and I think he had a brother or two, and yeah, for like 18 months he was working through all the dramas of all the government process that you have to go through. Versus if you got it documented, boom, executor takes control, follows the process, done. It's not the government. Um, so not automatically to the kids. And the other thing is, when you've got companies, trusts, superannuation, insurance, which is my last one there, that definitely doesn't just default to the kids. So yeah, there is ways it defaults, but when you don't put the person's name in, you risk undesirable outcomes. Um, the next one here, yeah. So we talked about trusts. Let's go to super. So the way to get some certainty around where your super will end up, then you can look at binding death benefit nominations, or the acronym BDBN. That's a piece of paper you can put in place to say, in the case I die, all my super goes to this person. Now, there is tax implications as well if the person you give it to is not a dependent. That's relevant sort of older age, when your kids might be adults, and you're not financially supporting them. Paying it to your spouse is tax free. Paying it to your kids, if they're non-dependents, and I say non-dependent financially. Of course, they're your dependent children, but they're adults. They're on their own feet at the time. You can pay essentially what isn't called inheritance tax, but that's effectively what it is. And this is current rules. So, and there's also been, additional taxes when it comes to passing wealth down through generations, discussed again by our lovely current government. Um, Next one is insurance payouts. And this is another thing that a lot of people don't consider. So, especially when people are building their wealth, they don't have a lot. They think, well, I don't need an estate plan or estate planning because I haven't got many assets. Well, there's a couple of things. If you've got life insurance, you could easily have hundreds of thousands or millions of dollars, depending on how much you're insured for, that lands in your either your personal account or in super, because you can hold life insurance in multiple places. Instantly your estate's worth millions. Whoops, you didn't get the paperwork. Yeah. Right. I'll yeah. So alternatively, if you have been a property owner over the last 5 or 10 years, your family home, assuming it's a family home, would have gone up in value. So your equity in that house needs to be considered. Again, if it's jointly owned, the rule of survivorship, so it's not your will's assets to deal with. But but let's say that remaining spouse, if they pass away, that will be dealt with under their will. So yeah, lots of things to consider. Got a question there. Do you still need a binding death benefit nomination for each other if both yourself and your spouse are in your own SMSF? Yes. Yeah. So even though you've got an SMSF and you're both members, you're still to some degree both considered separately. And so you'll have your own balance that's calculated separately. You'll have your own contribution limits and even rules around accessing the money. So when we've got spouses of different ages, one can usually pull money out earlier than another. Now, sometimes we don't want to send super straight to your spouse, and that's a nice segue into this slide. So testamentary trusts. So generally, there's two ways to pass assets to your remaining family. One of them is pass it straight to their own name, and doing a binding death benefit nomination from super straight to the person will put it straight in their own name. And if you've got $1 million or $2 million in super, you'll instantly make them a multimillionaire. And that might be a nice thing. It might sound nice, but if they run a business, then all of a sudden you've put a shitload of assets in their personal name, and that is unintended. So if my wife were to pass away and I still run Inspire the business, I don't want all the assets she owns and controls landing up in my name. I want them to go to what we call a testamentary trust, and you can do this with superannuation to send it through to a testamentary trust instead. Now, what that does is it keeps the assets separate from the name of the beneficiary. So they wouldn't end up in my name personally. They'd go over to the Stevie Testamentary Trust, and then I could have control over that trust, and not expose the assets to the risks of running the business. The other benefit of a testamentary trust is that distributions to minor children, so kids under 18, they get taxed as adults when they receive income from a testamentary trust. Separately, like if you distribute from a discretionary trust to a child under 18, there's a limit of $416 before they start getting taxed at 47%. Or something ridiculous. So, so yeah, testamentary trusts are different where they are taxed as adults. So they get the tax-free threshold of about 20K. Then they'll get taxed at whatever the rate is now, 15, 16% on the next bracket and so on. So it's someone has to pass away to create a testamentary trust, but not only are they great for asset protection, they're fantastic from a tax perspective if there's minor children remaining. That could be grandkids as well. That is all good too. So yeah, I mean, we assist clients. We're not lawyers at Inspire, but and I've got a slide on this too about the process. But we work with lawyers, and I don't think I've ever done a set of wills with a client that has not included a testamentary trust. So yeah, it seems to be the way to go, and the way most people want to to do it. And yeah, before I got that segue, I skipped over this one. Estate planning is also not set and forget. Um, so obviously get it done is the message of this section of the webinar. But keep an eye on it. So every couple of years, or if you have more children, or if you sell a property and buy the next one in a different name, keep checking in that it makes sense. Even massive increases in wealth. Let's say you get an inheritance, or your property value goes through the roof like it has. Make sure the way that your assets are structured are still like your estate plan matches the outcome that you want. I'm not suggesting your estate plan needs to change every 2 or 3 years, but you need to check that, hey, hang on, we're worth another $500,000 over here. Does this still make sense? Or in our case, we had a fourth child, last year, and does our will still consider our fourth child? That's the sort of stuff we want to make sure still makes sense. Oh, sorry. This slide just further talks about the testamentary trust benefits. So, option one, lawyers call this the I love you method of passing on inheritance, which is just send it from the person who dies to the beneficiary in their own name. But option two, person who dies sends it to a testamentary trust, which is separated from the beneficiary. So that's a visual way of sorting it out. Actually, another thing is that let's say you've got a child who will inherit a considerable estate. Putting it in a testamentary trust means it's protected against relationship breakdown if your child were to be in a relationship with someone who's not great, and they have a bust up, and you essentially don't want to start donating the family wealth that you created to now an ex-family member. Similarly, if you leave money or assets to your spouse and they re-partner, a testamentary trust will make sure that the assets are considered separate from that new, I guess, marital assets or relationship assets of that new relationship. So there is protection against relationship breakdown, is what I'm saying. Also, it's common for when you're considering testamentary trusts for your kids to say that, hang on, I don't want my 18-year-old to have control of $1 million if I was to die. I want to give it to a trusted, well, obviously my spouse first, but then we got to think backup. So if it's not my spouse, is it my brother or my sister, or and that's my kid's aunt or uncle, and you can appoint multiple people to make sure that it's managed properly. And the idea there is that, I don't know about you, but when I was 18, I probably didn't make the most sensible financial decisions. Do you really want your kid that hasn't learnt some life lessons to have immediate control? But you could leave some instructions to your people who would control it on behalf of your child to say, hey, if my kid wants to do uni, pay for it in full. If, set aside 100 grand for their first home as a deposit. Like, you can, I mean, the trustees or the people you leave it with don't need to legally follow those instructions, but I'm sure you're going to pick people who would morally be bound by what you suggest. So yeah, and again, like, people in that position would want instruction rather than try to guess what you were wanting from them to add value to the whole situation. So yeah, it's already going to be hard enough to deal with the loss rather than guessing what you wanted to do with it. Alrighty, so that's testamentary trusts. Yeah, valuable tool, and yeah, part of every estate plan I've been involved with over the last decade. Every one. Yeah. So what's the estate planning process look like with, this is particularly with us. So again, we work with business owners. There's complex trust companies, SMSFs. It's not just, two individuals going and getting their wills done. So what the process looks like, it involves you or in our words, our client, Inspire, and also lawyers that we work with to help close this stuff out for clients. And we call it advisor facilitated estate planning. So we're not writing the wills, but we understand it at a high, or call it even a medium level. But we're not there writing the clauses in the in the will and the testamentary trust and all that sort of stuff. So we gather the brief, talk with you about what your intentions are for your estate plan, and then work with the lawyers to get that sorted. Summarize and send to lawyers. We have a 3-way meeting with client, us, and lawyers. Documents are prepared, and then they're signed off. So that's the process. And again, we can, depending on the complexity of the client, it may involve, multiple companies, multiple trusts, SMSFs, assets in own names. Like it's all part of, I guess the scope of why we've put this service in place. And bless him, grandfather's passed away now, but his will was literally like 2 or 3 pages long from I don't know about a questionable lawyer, but a lawyer that I just don't think specialized in this stuff. Grandfather had a decent estate. He was a business owner. He had an SMSF, and he had a 2 or 3 page will. And I'm just like, no, don't do it. Anyway, I think even the will that gets prepared through this process is probably going to be 20, 30 pages long, because it includes the terms of the testamentary trust, assuming the person wants one. And that's before things like binding death benefit nominations or variations to trust deeds, if that needs to happen. Even things like successor director, things for companies. If you've got a single director company and that single director was to pass away, all of a sudden you've got a directorless company, which is not ideal in ASIC's eyes. So what have you got in place to immediately appoint a replacement director if one was to pass away, and to carry on the, I guess that whatever that company is doing. So yeah, there might be multiple sets of documents depending on how complex your situation is. What's this one here? Remember, your estate may be worth a lot more given investment property prices, life insurance. So I've mentioned that already as we've gone. And again, that's just to, uh, again, I've heard it so often. No, I don't really need this stuff because I'm not worth much. I mean, there's probably only a certain amount of time or years that you'll be able to use that excuse. But just remember life insurance as well, which will immediately put a sizable payout, assuming you're covered for it, straight in some person's name or entity's name. Whew, alrighty. So yeah, we've got a few minutes left until midday in Queensland here. So I'm very open to answering any more questions if anyone has any. But a lot of content we covered today. I hope it's been helpful. And yeah.
I got
Any
a
other?
question, Ben.
Yeah.
The when you do up the will and stuff, is that best stored with the lawyers in like their filing cabinets, or can you get it written up and throw it in your safe? Where's the best place for that to be stored?
Great question. So we've got clients who get the lawyer to store it. We've also got clients who just store it themselves. You want to make sure your executor knows where it is, and even your backup executors. So that's one of their roles, is to find the most recent up-to-date will, and if you were to cark it, and then so letting them know. And you can also have multiple copies as well, as in like I can't recall whether you can sign them in duplicate and triplicate, but photocopy it, have electronic copies, send one to your accountant, send one to the lawyer. Like, yeah, that's probably the best place to do it. And I know that Barefoot Investor suggests a fireproof safe, given I think his house burnt down. That's one of the stories he shares in his book.
Yeah, cool. Thanks.
All good.
If
Damien,
I
did you?
could
Yeah.
throw in some remarks. I'm a lawyer, but I don't practice in wills and estates.
Yes.
Um, but just to Daniel's question, I've got a friend who had a friend that passed away, and the first thing you've got to do when someone passes away is, particularly when they're on their own, is organising funerals and what have you. And they had to get rummage through her house to eventually find it. They found the will. But I agree with you, Ben. Send it off to the executor. Make sure the executor, as a courtesy, you should be asking the executor as to whether or not they're prepared to take on the role, because,
Yes.
but I say it's not an easy task. It's a bit of a shitty task, if I can use that term. Um, that's the first thing. But in terms of your earlier questions about someone passing without will, the estate is what they call intestate, and it's a process of making an application to the Supreme Court, and you've actually got to reconstruct it, and it's a very, very difficult and complex and costly process. What be said for having a will prepared, you know, and recognizing that sometimes these things are drafted, and life travels very quickly. I've got people that come to me having, family members have passed away, like your grandfather you referred to, Ben. Things that were drafted 30 or 40 years ago, and their assets and circumstances have changed significantly. Particularly when you're talking about specific bequests to people. That's what
Yes.
you should be thinking about. You might have someone that you want to give your golf clubs to, or there might be something that's particular, or something sentimental to your kids, etc. They're the sorts of things that you want to expressly set out in your will. And it gets a bit complicated where people become estranged from their kids or relatives and what have you, and dealing with that, and not only in the will but ancillary documents that explain why that's the case. If you want to have your intentions in the will follow through, but I'm using Ben's disclaimer. That's not legal advice. Get advice, but if you're interested in not having a will, you can look up intestacy. There's plenty of information out there on the web in the New South Wales or Queensland jurisdiction about people who die without will, and I wouldn't encourage it.
No. Yeah. There is also a too late as well, where if you've already lost your marbles, you can't go and put it in place. I mean, yeah, pretty awful place to be, but yeah, that's also something else to consider.
Two things to think of there too. There's the will, obviously, and you've got to have competency to be able to prepare a will. There's also a power of attorney you should be thinking about too.
Yes. Yeah.
Speak to your lawyer, and the two should fold into one another. And then to Daniel's question, where's it going to be stored? If you want to appoint someone as your power of attorney, you should be giving them a copy. Anyway,
Yeah. And actually, that's a good point. That's part of the paperwork that's generated through our process as well. So not only the wills, but the power of attorney, and then there's add-on documents like a BDBN, if that makes sense. We can, obviously do the trustee variations, and stuff with companies if we need to as well. So it's all part of the same consideration. Yes. All righty. Well, I can't see any other questions coming through. But that's I haven't actually shared on this topic for a very long time, so it's been nice to revisit it. And thanks everyone for showing up, and I hope that's helped in some way. And have a lovely rest of a Friday and weekend.
Thanks, Ben. Thanks, Damien. Appreciate it.
Cheers.
Cheers. See you.
Thank you.
Bye-bye.
Thank you. Bye.
Bye-bye.